Our advice to all luxury home service providers is make sure you have sound business fundamentals. You have to have the margins in place. You have to have the cash flow in place, or things can turn really quickly. There's another company that we just met with recently, Custom Integrator, very good sized company, well respected, does great work, been around for a lot of years, and they're borderline insolvent.
Welcome to the FlyWheel Effect, the podcast where ambition meets expertise in the world of luxury home services. Whether you're an entrepreneur, a small business owner, or a forward-thinking professional, this is your platform for growth, profit, and prosperity. Each episode, we dive deep into how to leverage data for smarter business decisions and share insights that help you transition from technician to visionary. Let's jump in.
To another episode of the FlyWheel Effect. I'm Brent Sonnek-Schmelz here with my business partner and co-host Matt Bernath. And today we're going to be talking about the economic environment and what's it looking like out there for luxury home service companies. You know, there's a lot of new information, a lot of uncertainty, and it should be a useful conversation. We're also going to go over the big acquisition, bombshell last week, between Snap and ADI. That could get some interesting things going on in the custom installer industry. Matt, just want to start off, how you doing today?
I'm doing great, Brent. Thank you. It's Friday. Looking forward to an amazing weekend. Have had an incredible week and always enjoy our time together. So really looking forward to this.
You got any good plans for this weekend?
I get to get back on my mountain bike, which I've enjoyed the last couple of weeks. I've traveled so much that finally get back to hitting the trail. So I'm looking forward to that and spending some one-on-one time with my girls. And then it'll be Monday before we know it and rock and roll into another week.
That sounds awesome. I'm looking forward to spending some time with my kids and maybe cleaning out the shed. So that'll be great. All right. So let's just get into this. So one of the reasons that brought this episode to a head is the news that last month in March, inflation was up again 3.5%. That's going up from the prior year, 3.5% over the prior year. It's higher than what was expected. And it's going to have a dramatic impact on what we're seeing with interest rates and the buying capacity of consumers out there. As you know, there's this whole conversation in the news about bad vibes. What is a bad vibe? Bad vibes is, hey, the economic environment is pretty good, but people don't see it. They feel pain, and inflation is a core component of that. And what I want to get into is how that affects our industries that we pay attention to. You know, we're primarily in the CI business, custom integrator. We're also thinking about the other luxury home services, pools, fences, roofing, etc. And inflation hasn't put a halt to our businesses, especially in the luxury end. Matt, I think even though we've had this inflation, our customers, clients at Vital, our members, and the people we talk to, they haven't seen a big decline as a result of the inflationary environment over the past few years, have they?
You know, I think it's hard for them to put a finger on exactly what has changed, but it's market by market. And I would say probably half of our members are experiencing or have experienced over the last year a reduction in new project closes or, you know, project closes taking longer. And I think the frame for that is what happened around COVID, which now, of course, that was, 4 years ago, the pandemic. But because we're in a project-based environment, these new sales that happened during 2020, 2021, and really into 2022, they're trailing off. Those projects are now finishing. Those jobs are getting completed. And so we're starting to see the effects in certain markets of just a lower sales trend over the last year. And again, that's not broad. That's, I would say, probably 50%. But it's enough for us to pay attention to.
And when you say sales trend, you're talking about their future pipeline of projects, right? Like
new sales.
New sales, right? Yeah, it's interesting. I wonder, because our projects that we look at are so high priced, whether they're going to keep up pricing and be able to maintain margins as inflation affects other things. One of the areas that inflation is going to affect dramatically is cost of labor, especially on the lower end labor side. Wages are going up, minimum wages are going up. It's going to be harder to find labor to do the work. And maybe you're going to have to pay them more. And it's unclear to me whether you're going to be able to transfer that into higher prices. The other things that are higher now are financing costs. You're buying a new truck, you're paying, 10, 12% instead of 2. Those are direct impact on the bottom line of luxury home service providers.
Absolutely. And I think the small percentage of luxury home service companies that are paying attention to those metrics will be in good shape. The larger percentage of them, or the majority of them that aren't paying attention to these things, are going to end up upside down. In fact, I just got a message the other day of somebody in a particular market who was a custom integration company who's insolvent. They're about to go out of business, and we haven't seen that in a long time, right? I mean, these many luxury home services companies are relatively easy to stay in business. Now, making the kind of money they should be making is a different story, but keeping the doors open isn't that hard for these folks. So I think we're going to see more of that, and for those companies that are in a position to acquire the assets of those businesses, I think that's an important thing for them to look at. So back to your question is, how does the higher cost of labor transition into pricing? I think if you're paying attention to it, it's fairly straightforward to raise your prices accordingly. We'll have to see what the market can bear. I think in the luxury world, it is what it is, because they're paying more for services across the board. And labor, there's a labor shortage that we have to deal with until the next major Great Recession. And until that gets resolved, which may not be for, till the end of the decade, labor is a finite resource. And finite resources, unfortunately, are just going to continue to be more expensive.
Yeah, and I think we're looking at unemployment where it's at 3%-ish, a little bit higher. And in some of our primary markets that we look at, I think it's much lower than that, right? In some of the major metropolitan high income areas, it's under 2. So you can't find good people. You have to charge. I think one of the things about pricing, though, it's interesting, is in this environment where things feel more expensive because of inflation, things are absolutely cost more because of higher interest rates, which are not going to be coming down anytime soon. And that's something else I'm going to get into. And you have competitive pressure in the marketplace. Fear also is a driver of, I think, an inability or lack of will to try to raise prices at all. And so we might end up seeing margin squeeze because other competitors who are worried about that insolvency are willing to take less margin to get the same job.
Yeah, absolutely.
And so it's a cycle.
I think that's a great point, Brent.
And for all the integrators you're talking to out there, other than the one you just mentioned, that's insolvent, I want to get into that a little deeper. Have you encountered places where they are expressing some fear in what the market's going to bear over the next 6 to 12 months?
I think there's a lot of uncertainty. My take on what I'm hearing out there is that due to the COVID bump in revenue and also new projects, I think the majority of integrators feel like they'll be okay. But from some of the numbers that we've seen from non-members, through our financial benchmarking work, there's a good amount of integrators out there that are very close to being out of business without even knowing it, primarily on the cash flow side. And I think what you just described about trying to hold the line on pricing, without raising prices to try to continue to capture market share, ultimately that will be a spiral down for those companies because they're relying on new jobs to finish old projects because their cash flow is poor or they're just not making the kind of money they need to make. So, our advice to all luxury home service providers is make sure you have sound business fundamentals. You have to have the margins in place. You have to have the cash flow in place, or things can turn really quickly. There's another company that we just met with recently, custom integrator, very good sized company, well respected, does great work, been around for a lot of years, and they're borderline insolvent. And, it doesn't matter how big or how small you are, the problems are the same. They just have a different number of zeros at the end. And right. In fact, some of the larger companies, they fall faster than the smaller companies. So we're just trying to spread the word, not in a fearful way, although it certainly sounds that way, spreading to the word of, hey, just keep an eye on your metrics, know what's happening ahead of time so that you don't get surprised by this thing and get into a point where it's too late. And nobody wants to lend you money, and even the money you might be able to borrow is going to be ridiculously expensive.
Yeah, I think that cost of borrowing is huge. But I want to dial back. One of the point you made is, I agree. We don't want to think about fear. Really, what you want to do is think about this as an opportunity. The companies that are able to dial in their metrics are able to have good cash flow, not pay payroll out of deposits, for example, right? Like that's a no-no. And be able to make sure that they have equity in their business. They will be able to get credit somewhere, and they are going to watch their competitors wither away and die that aren't running good businesses. And so that when it turns back on, they're going to be there to pick up all the great jobs. And I think that's the perspective that you need when you're facing, hey, it's been great for years and everyone says it's going to turn at some point and it hasn't. We just know that it will. It's just a question of when. So make sure you're in line, right? I think if you can make an opportunity, you can survive and thrive throughout any environment.
Yeah, absolutely. And, something that just popped into my head related to your earlier question about, whether companies will be able to pass along the additional costs to the consumer. That's always really tricky in a project-based environment because we're selling jobs today. Again, whether you're a window contractor or a pool contractor or AV business, you're selling jobs today that will turn into revenue in some period of months or years down the road. Especially these luxury homes take a long time. So you don't really know what your true labor costs will be. It's always an educated guess. So that's part of the issue. Part of the challenge is staying ahead of that. You really should be, your pricing today should take into account what you think it's actually going to cost you down the road to get this work done. So that's one point. Right. And I think the concern that I have for those companies who are going to try to hold the line, not pass along those costs, is the consumer ends up losing. Because when you squeeze margins in a business, what ends up getting squeezed is the end result, right? You don't end up having enough hours or enough labor or quality people on staff to do an incredible job that you promised when you sold the project, months or years ago. And so that's the big cautionary tale here is you think you might be smart in holding the line on pricing so you can get the job compared to your competitor. But when it comes time to actually complete that job at the level you promised, it becomes really tough if you don't have the margins in your business and the cash flow to do so.
Yeah, it's a great point. I think there's the cutting corners, and the end result is one of those red flags that a business is really in trouble, and it goes south quickly because reputation suffers. They don't get the next projects. They don't have the cash flow going forward. They've now cut their cash flow in the past, so there's no way to go but down.
Yep.
So with that, I think we're talking, one other point I want to bring up on this before we flip over to Snap is the housing environment. There's two components to housing, as most people listening to this, I imagine, will know. You have existing home sales, which is obviously the 140 million-ish homes out there in the marketplace. And you also have new construction. Existing home sales right now is at a 30-year low. It's April. I don't know about you and your markets, but I walk down the street where there used to be a for sale sign in every other house. Now there's like two over the course of a mile. And sometimes they sell really quick. Sometimes they sit there forever. It's who knows what's going on. Pricing, though, because for the most part they are selling, pricing hasn't come down. Because nobody can move. Nobody can afford to walk away from their 3% mortgage they signed up 10 years ago. On the new home sales, which was holding the line fairly well for a little while, it looks like that has now at a cyclical low as well. The housing companies are no longer expected to build at the same rate that they have over the past several years. And that's going to be interesting for home services. I think it's going to be a flip. There's all the companies that are focusing on new home construction or on the move market, which is a lot of remodel, are going to have an interesting time relative to the people that really focus on home upgrades for the consumer. And I don't know, Matt, is this an area that you've been talking to any of your members out there about what they're seeing with the different changes in the housing market?
Yeah, those are all interesting points. We advocate that our members in their markets get as much leading data as they can. And What we end up seeing is that, we recommend they stay in touch with their major home builders on a regular basis. And, clearly they're going to get some good quality data from that and some, fictional data. But no matter what, it's important for them to, to stay in communication regularly with what their new home builders are forecasting. That's critical. But you can't rely on that because in many cases, that's too far out for them to accurately predict. Beyond that, or really, I guess, ahead of that, is keeping track of the pace of new leads coming in, right? And so that's really critical for any business, is the velocity, the sales velocity, not just in closed sales, but in new leads coming in. And so we encourage our members to look at that. It's not a report that we look at directly with them on a regular basis, but it's something that we encourage them to stay on top of. What we do look at every month is their overall sales close velocity. And we are seeing in some markets, as I mentioned earlier, over the last year, overall sales velocity going down. And that probably ties directly to some of what we're seeing. And I imagine it will continue to get worse unless they're focusing on remodel work.
And I think the remodel work has to change as well. I think a lot of remodel work, think of it, is around the move. You buy a house, you try to make it your own. Nobody's moving today. As far as at historically low levels of people moving out of their current home into a new home, whether it's a new or an old new. The choice to remodel your existing home is a very, very different one than the one of remodeling the house you are about to buy or just buying. So those decisions, I think, have different inputs, and it's going to require a different communication style from home service providers on how they secure that business. I'm not sure what it is because we've really never seen this environment before, but the ones that figure it out, I think, are going to be much more successful.
Yeah, I agree. And I'm purely speculating here.
Me too.
I have no data to back this up. But when we talk about remodeling existing homes, so not the mover type remodeling that you're talking about, I think a lot of that is behind us. I mean, if you look at how successful remodeling, the remodeling industry and contractors around that industry have been in the last few years around COVID, in the lockdown, I don't know how much more pent up demand there is, or how much demand there is for remodeling existing homes. I feel like, that may be behind us. But again, that's pure speculation. I don't know. I'm hoping that's not the case. I'm hoping there's still plenty of demand on the remodel side.
Yeah, that would be interesting. And that would be how that plays out is going to have a dramatic effect on the revenue of various home service companies over the next 18 months. Because we know that people aren't moving now, and it takes time to move, and it's unlikely that over the next 6 months, as interest rates stay where they are, 30 mortgages now are over 7%. The Fed isn't expected now, where they were expected to have maybe 2 rate cuts this year, with inflation over 3.5 and unemployment down below 3.5. Right now, the trend and expectation is no rate cuts through the end of the year. So mortgage rates are not going down at all, nor business lines of credit. So if people have already spent the money in their homes, it's not going to be a maintenance other than maintenance. We got to make sure that our balance sheets are in order to weather that storm.
Yeah, I agree. And I think there's also a little bit of a perception thing out there that, and again, this is purely speculation, but from what I'm hearing through conversation, that there's probably some demand for remodel work that's sitting on the sidelines waiting for the interest rates to come down so that they can get a HELOC or refi or whatever the case may be to free up some cash. Right. So I think we have a perception, and I don't know if I'd call it a problem or an opportunity, but maybe there's this reality we never see those rates again. And at some point that demand frees up because people realize I just need to get the work done, even if it's going to be at 7%. So I don't know. I mean, again, I think we're just going to have to see where that plays out. Our emphasis to our members and really every home service business or every business period is you need leading indicators. You got to watch your metrics because in your marketplace, things are going to be different than the macro, economic environment. So got to know our metrics. We need to have leading indicators to tell us what's happening out there in the marketplace. And, lead flow and sales velocity are among the best.
All right, great. Now let's use this opportunity to flip over to the big bombshell in the custom integrator world of Snap One, a public dominant company being acquired by ADI, which is owned by Residio. So call it ADI or Residio. Huge, I think $1.4 billion approximately in that range. Shocking to everybody, but probably shouldn't have been. I mean, it's interesting to watch, see what's going on with Snap there. What are you hearing out there, Matt?
Yeah, I mean, to address your comment about shocking, I wasn't that shocked, and I think there are some people that were, and I don't think you were, but I think overall, like you said, it seemed shocking, in the media, but it makes a lot of sense for a lot of reasons that I think you can better spell out than me. What I've experienced, and again, this is just talking with our some of our members, but also the chatter on on all the forums out there, is that that ADI and Residio have a bit of a perception problem to overcome, and I think the perception from the custom integrator market at large is that they're they can be difficult to do business with. They they don't really care about their customers. They're just numbers, things of that nature. And again, whether these are real or not, I don't know. This is a perception, and in many cases,
Right.
Perception is reality. And I think there's a number of other issues that you brought up that I'd love to hear your perspective on.
Yeah, it's part of the reason what I think about the why did this transaction happen and why did it happen now. And I think you have to look at the ownership of Snap One as really the big driver. Snap One has been owned by a private equity firm, Hellman and Friedman, since 2017. So that's 7-ish, 8 years. And in that time frame, a private equity fund in 7-ish, 8 years expects to monetize their investment. I'm not sure what they bought it for back then, but I'm sure it was a whole lot less than $1 billion. And I'm sure they've done quite well. But it's now time to clear this out of their portfolio. They went public in 2021, so in COVID, expecting this thing, Snap, to grow exponentially over the next several years, and they be able to sell off pieces of their equity in the public market throughout that period and monetize it. Even today, they own over 70% of the stock of Snap One is not part of the public trade. But they went public at about $20-ish, 3 years ago, 2.5, 3 years ago. They're now at 10, got dipped all the way down to 7. There's no way that Hellman and Friedman can sell any of their stock. So they're like, what are we going to do here? Let's just unload. Let's move on. We're making a profit, probably make 3-4 times our money over this period, plus whatever we took out of it. Find the buyer and let's go. And as far as buyers go, ADI was the perfect buyer, right? They're a buyer that understands distribution. They understand product. They have a huge security business. They deal with the smaller guys, but honestly, so does Snap, right? Snap is a distribution company more than a direct dealer company with Control4. Control4 is the big nut with Snap. So it fit. It was an easy add to ADI to build up their basic book of business by about 30%. The price, they could say, hey, that's reasonable. They also brought a new private equity owner in, Clayton Dubilier and Rice, who is one of the big guns historically. And they committed a bunch of capital and are going to take some board control as well. So there's a lot of moving parts on the financial engineering side of this that really have nothing to do with the CI business, but I think were some of the driving factors to make this happen. Now, to your point, Matt, I think the ADI is trying to make up for some of their problems with market perception. I'm not sure Snap does that for them.
Yeah, I agree. I don't know that it does either. And I think what's really interesting in a conversation that we had the other day with some other partners was, there are no Snap One branded products out there either. So it's really interesting. We might end up seeing the Snap One brand go by the wayside completely after being around for 15 plus years, right? Because ultimately every one of the products that they sell, which is what ADI and Residio want, they're not Snap branded products. So it's going to be interesting to see. I was reading a little bit more about the motivation behind, ADI and Residio and their purchase of Snap. And, one of the big motivators is how solid Snap's house brand lines are. And ADI and Resideo have continued to move, I'd say in the last 10 plus years, continued to move away from selling other people's products and into selling their own. And I think this is probably an accelerant for them in that way. Whether that's good or bad for the marketplace, I think, it's yet to be determined. They're now going to be in the cloud services business with Snap One's Oversee product. Right. And of course the control system business, which they haven't been in before, now they have control for. So my hope for the industry and for our integrator partners, and really for the end users, is that ADI Resideo realize the strength of Control4 as a brand and continue to level that brand up versus letting it fall by the wayside. I think that would be a huge opportunity and potential threat for them, as well as their Oversee, some of the, I would say the top 3 strengths that Snap has: Control4, Oversee, and I think, historically their tech support has always gotten high marks. As long as they make sure to emphasize growth and stability in those products, I think we'll be okay. Then their only challenge will be this perception problem they're going to have to overcome.
That, but to that first part about product is they are not a company with a culture of investment in R&D. And those brands, whether Control4, reinvesting in Oversee, even things like Parasol and Wattbox, which are, technological products, it'll be interesting to see if ADI and Resideo have the internal mindset to reinvest cash flow into them. I'm not convinced and I'm not sure, but it'll be interesting to see what happens. I also think that, to your point about house brands, we have what's going to be the fallout for a lot of brands that depend on ADI right now for sales, where you have now the competitive Snap product where they couldn't sell in Snap before coming into an ADI location and pushing them out. A company like Nice, which has a lot of brands with 2 gig and such going through ADI, what's gonna happen to them? It might be some difficult conversations there on the vendor side.
I think there definitely will be. And, the thing I'm not looking forward to, which I think is inevitable, and it's because I have so many friends out there in this world, is the inevitable middle management cuts that are probably coming, and also the ground level at the branches. I think Snap One and ADI have probably a lot of overlap in these marketplaces for distribution branches. And, my hope is that, many of my friends and colleagues and really strong players out there in the industry are able to level themselves up and retain their positions and grow. But I've seen this happen so many times that isn't always the case. So it's unfortunate.
No, there's definitely going to be cuts. There's going to be people looking for positions, and really, really good people. And the smart people, the smart companies in the industry will recognize that those good people can provide real value. And it's just so there'll be some moving around. And I think ultimately that's painful for a lot of people in the short term, but it can be very valuable for the industry in the long term, as long as the good people find the right places.
I agree. And I think this will be a boon for some brands. Josh AI is positioned well to take advantage of what's happening out there in the control system world. And I know we don't want to talk too deeply about specific brands, but I think that's one that is clear and obvious to everybody that they're positioned well to take advantage of the chaos, because chaos breeds fear. And unfortunately right now, there's a lot of uncertainty. There's a lot of chaos. There will be at the end of this year when this deal is done, and chaos breeds fear, and fear breeds, decisions, right? So we'll see how that plays out. But I think there's a number of brands that will scoop up great talent. Hopefully Vital is one of those. We're definitely in a growth mode as well. And I think there's definitely going to be some great people, like you said, on the sidelines, which you made a great point. It's short-term pain, hopefully long-term gain for them.
And just want to highlight something Matt just says. Vital is hiring. If you're listening to this and you're looking to transition, please give us a call. We're looking to talk to great people. So with that, I want to make one last point about Snap, and I want to give them credit, not for necessarily their what they are right now, which became over-levered. I'll say it, even though I probably shouldn't. Is too many Harvard MBAs. I'm not a Harvard MBA, so I can say it. But you don't want to put too many of them in a room. It causes all kinds of problems. Not where they are now, but where they were when they were Snap AV, and they, in many ways, revolutionized the industry as finding great product, simple SKUs, great customer service, easy ordering, and it made doing AV a joy for a lot of integrators who dealt with convoluted things in the past. And so many other vendors brought that mentality in-house that it's made our industry, I think, more efficient. I want to give them credit for that somewhat revolutionary tack they brought into our industry 10, 15 years ago.
That's a great point. I love that. And I absolutely am 100% behind it. I think they also, in them going public and doing what they did, as challenging as that was for many people to understand why and how and everything about it, it moved our industry closer to being on the map and better understood by, investment firms and companies. And, this is the reality of the maturation of our industry. But I agree. I believe in the last 15 years, they've helped to level up this industry in a significant way.
It's been great for vendors. It's been great for integrators. It's been great for the consumer. So let's give credit where credit's due.
Absolutely.
All right, that's it. Unless Matt, do you have anything else to add?
No, this has been great, Brent. Really cool topics. Thank you for bringing in your perspective on all of these things. And just always love talking with you.
Great. And thank you, Matt. And for anyone out there listening, if you'd enjoy this conversation, we don't have any advertising. We ask only two things. Hit us a like and a review if you can. And if you think it's valuable to someone you know, please send them the link and refer our podcast. So until next time on the FlyWheel Effect, this is Brent Sonnek-Schmelz and Matt Bernath. Thanks a lot, everybody.
Thank you.
Thank you for tuning in to the FlyWheel Effect. Our journey through the intricate world of luxury home services continues to be fueled by your passion for excellence and innovation. If you found value in our conversations today, don't forget to follow us wherever you get your podcasts. More insights and resources, visit us online at growwithvital.com. Until next time.